Hey there, it's Ted Thatcher, president here at Bright Lake Wealth Management, and I wanted to bring you another market update today. So today, the Fed came out and announced that they would be lowering interest rates by 25 basis points, or 1/4%. There had been discussion about whether they would look at a 50 basis point or 0.5% cut, or if they would stick with that 25 basis point number. Ultimately, that is what they landed on, and truly that is what most economists expected coming into today's meeting. We got a whole lot of mixed economic data for the Fed to sift through coming in to this meeting throughout last week and early this week. And so let's talk about each of those economic vital signs. So first, one thing we measure a lot is how the dollar, the US dollar, is doing relative to other currencies around the world. And because of the new change in tone when it comes to fiscal policy, we've actually seen the dollar value slide. We've seen it slide almost 10% year to date. That is definitely a consideration here. Further, we saw the CPI, the inflation data, come out a little bit hotter than expected. It's now at 2.9% year over year. The producer price index, which is a little bit more of a leading inflation indicator, slightly came down, still though sitting at 2.6% year over year. Very notably, in August, the unemployment rate ticked up further. We've seen a lot in the news headlines lately around revisions when it comes to labor data and jobs in the United States. That number ultimately now sits at 4.3%, which is higher than it has been. Now, when I break into that figure further, what's really interesting to me is how it affects different sects of the American economy. If you look actually at young Americans, they are the ones that are most affected by the unemployment rate. With those working between the age of 16 and 24, the unemployment rate has actually gone up substantially. It's now sitting at 10.5%. And so it dovetails with this general narrative that for young people, the economy has been a little bit of a fight. It's been quite difficult, actually. We've talked a lot about housing access and whether young people can get access to homes. Obviously, high interest rates have been difficult for that. Younger people, of course, are also earlier on in their careers, which means their salaries, their wages haven't gotten a chance to, grow over time. So they're more affected by inflation. And so now we're seeing that not only stop there, but also trickle into the actual unemployment rate itself. And so while those things, those vital signs, I think are a little bit of a dimmer picture, one highlight has been the retail sales numbers that came out earlier this week. The retail sales data for the month of August was actually up 0.6%, so a little over 0.5%, which, of course, when we're talking about, 1/100th of a percentage point, sometimes it doesn't feel really important. But what economists actually expected was only about a 0.3% increase. So to see a doubling in spending from the American consumer actually is a real positive for the economy. It means that the American consumer is more durable than we expected. Now, of course, with all data, we can also cut that up and look a little deeper. And so I will say, when we do look under the hood at where consumer spending and retail sales is at, what's really interesting to me is that if you look at the data, we actually find that the top 10% of earners in the United States, so think those people that have higher salaries, and certainly north of $200,000 a year, maybe $250,000 plus, they account for nearly 50% of retail sales spending in the United States. And so we are seeing sort of that narrative that I was explaining earlier. So younger people earlier on in their careers definitely having a more difficult time in our economy today, and a lot of the benefit, certainly from the financial markets and from those with the higher salaries, funding a lot more of that spending than you might expect if you just look at the number at face value. So ultimately, where do we go from here? Of course, we are looking at all these different points of data. We're looking under the hood. We're evaluating how we want to apply this to our investment strategies and retirement plans and all those types of things. And so I just would take half a step back and say, in all practicality, this move from Jerome Powell does signal a little bit of a tone change from the Fed, but really what's going to matter is what the Fed does between now and the end of the year. And of course, the Fed has another series of meetings between now and the end of the year. And so the direction they take coming up is really what's going to determine the direction for these things. And further, we really want to keep our eyes on the data points as they continue to come out across those types of topics that I've been discussing. Inflation, production, right? We want to see how the country's producing with GDP. We want to see what's going to happen, whether we see stagflation or whether we see the labor data continue to slip. Those things are really going to inform what ultimate track the economy takes here and what ultimate decisions are going to make sense, perhaps from a rebalancing or a risk management standpoint when it comes to our portfolios. So a very data-driven discussion here today, but as always, we're here for you. If you have questions, you want to discuss how this might be affecting your investments, by all means, we'd love to talk to you about it. Give us a call and we can schedule some time. We'll be back with you again soon. Thank you.